Picture this for a second. Interest rates start dropping in 2026. Headlines say cheaper money is back, and most people relax, thinking it's just good news for loans. But the truth is, this is one of those rare moments where a small window quietly opens. And the people who recognize it early don't just save money, they build serious wealth. If you understand how lower interest rates actually move the financial system, you can position yourself ahead of millions who will only react after it's too late. When rates fall, the cost of borrowing drops, and that simple shift sends a ripple through nearly every part of the economy. Mortgage rates decline, credit becomes easier to access, businesses expand faster, and investors start moving capital more aggressively. This is why historically, periods of falling rates often line up with strong performance in stocks and real estate. But here's the key most people miss. By the time the average person feels confident enough to act, asset prices have already started climbing. The early movers are the ones who capture the biggest gains. Let's talk about real estate first, because this is where the impact becomes obvious. When mortgage rates go down, affordability increases instantly. A buyer who could only afford a $300,000 home at higher rates might suddenly qualify for $350,000 or more. Multiply that across millions of buyers, and demand surges. Prices tend to follow. Investors who lock in properties before the rate cuts fully ripple through the market often benefit from both appreciation and lower financing costs. On top of that, refinancing opportunities can reduce monthly payments later, boosting cash flow. This is exactly how many Americans quietly build long-term wealth, buying when financing gets easier, not when headlines say the market is hot. Now shift to the stock market, where lower interest rates create a different kind of opportunity. When rates drop, savings accounts and bonds typically offer lower yields, pushing investors toward equities in search of higher returns. At the same time, companies benefit from cheaper borrowing, which can increase profits and expansion. This combination often lifts stock prices, especially in growth sectors like technology and consumer discretionary. If you're consistently investing through vehicles like a 401k or a Roth IRA, this environment can accelerate compounding in a powerful way. But again, timing matters less than positioning early. Waiting for certainty usually means buying after the biggest moves have already happened. There's also a lesser-known angle that can quietly make a huge difference: debt strategy. When rates decline, refinancing high-interest debt becomes one of the fastest ways to improve your financial position. Lower interest on credit cards, personal loans, or even student loans means more of your money stays in your pocket each month. That extra cash flow can then be redirected into investments, creating a cycle where lower rates don't just save you money, they help you grow it. This is where understanding your FICO score becomes critical, because better credit gives you access to the lowest rates and the biggest advantages when this shift happens. What's fascinating is how psychological this cycle is. When rates are high, people hesitate, they delay decisions, and they hold on to cash. When rates fall, confidence returns, but often too late. The wealth gap widens during these transitions because a small group acts based on strategy, while the majority reacts based on emotion. If you can stay disciplined, keep your financial foundation strong, and recognize the signals early, you're no longer just participating in the economy, you're using it to your advantage. So as 2026 approaches and the conversation around falling interest rates grows louder, the real question isn't whether rates will drop. It's what you'll do before everyone else realizes what that means. Will you position yourself in assets that benefit from cheaper money, optimize your debt, and stay consistent with your investments? Or will you wait until the opportunity becomes obvious and more expensive? Because in finance, the biggest rewards rarely go to the smartest person in the room. They go to the one who acts early while everyone else is still watching.